Joining me right now is Oxbow Advisors Managing Partner Ted Oakley. Ted, great to see you. Thanks very much for being here. What are you expecting from this boatload of data this week?
Well, you know, it's a big week this week. If you look at everything that's coming out with consumer prices, producer prices, this is probably the biggest week this month as far as things coming out. I don't see a lot in the inflation numbers coming out. I don't see any big surprises, so we'll just see how it plays out.
Cheryl, I know that we've got to watch oil and what happened during the month in order to get a good sense of the CPI. But retail could even be a bigger market mover, right? Because you've got earnings from retailers and you've got overall retail sales. Good window into what the consumer is doing, Cheryl.
Yeah, and I think even more better said, Maria, is going to be what does this mean for the economy? I think that this month and these numbers, and I'd love to get Ted's perspective, are really going to give us a clear picture of actually how the consumer is doing. Ted, we know that they've been saving less money. We know that they've been charging their credit cards higher. Now we're going to see, did they spend in the quarter? Are you expecting a little bit of a slowdown as far as the consumer goes in these numbers?
I would expect it because if you look at consumer sentiment, it just hit a 3-month low. I think the consumer right now is realizing that, hey, I can't stay up with it, so we're going to have to cut something. So I wouldn't be surprised if we don't get a slowdown on the retail side.
And, of course, interest rates have been reflecting that. The 10-year Treasury yield this morning, let's take a look at where we are, way down from the 5% that we were talking about last week or 2 weeks ago. The 10-year is now at 4.628%. 4.6%, Ted, down almost 2 basis points ahead of the CPI out tomorrow and the PPI and retail sales out on Wednesday, housing starts and building permits on Friday. The Wall Street Journal is writing that low wage pay is surging and it's over. It's threatening the consumer boom. Ted, what about the low wage pay surge and looking at the consumer boom getting affected by wages having come down?
Well, I think one of the things that happens is you come into a slow it down at all. If things are slowing down, people at the low end are going to get hit first. I mean, you know, that's what you do in a business. You're going to cut the people that have your lowest level people, and I think that's what you're probably getting into right here.
Yeah. Do you care that Moody's has cut its U.S. ratings outlook to negative? They were at stable. They're talking about rising risks to the nation's fiscal deficit, Ted. Does this become a factor for you in any way as you allocate capital?
Oh, for sure. I think we're at one of the worst stages as far as debt. I mean, people don't realize really what's going to happen in terms of just rolling over the bonds that are coming due the next 2 or 3 years. So that's what we're seeing.
Jay, your thoughts on this Moody's downgrade, the Fitch downgrade here, and Moody's is also weighing in. Your thoughts on whether or not this affects markets?
I don't think it's going to really affect the markets too much. I mean, we may sell off a little bit on that news. They're a little late to the party, quite frankly, and now they have an opportunity to downgrade. I mean, it was August of 2011 where the S&P downgraded, and then it was several months ago where Fitch did. So now they have an opportunity to join the ranks. And as far as market reaction, at this time, no. The government shutdown could affect how they proceed with that. But if we do shut down, we'll probably sell off into it, and we tend to rally after a shutdown. There have been 20 of them since 1976, and we've tend to rally after most.
Ted, how are you allocating capital right now?
Well, we have a high allocation right now to short-term treasuries, more than we have had probably since 2000. We just feel like that when you get that kind of yield, there's no reason for us to have to try to catch a falling knife, so to speak, and that's where we are. So we're looking at it from that standpoint. We're really fairly defensive on a lot of consumer staples, and so from our standpoint, you don't have to get on the bus here. I mean, it takes a long time for a bull market to take off. So I think we're in okay shape from that standpoint.
So do you expect a year-end rally, Ted?
I wouldn't think so. We really felt like the market peaked in July for this run. And I don't think we'll get more than that. That's from our standpoint.
And is that because you see a changing macro story?
We do. We see a slowdown. You know, I don't know if we go into deep recession or anything, but we certainly see the numbers slowing down from all the way across in terms of earnings and what we could see in the first and second quarter.
All right, we will leave it there. It's great to see you, Ted. Thanks very much. Ted Oakley joining us this morning.
Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.